Yeah, I'm losing my
Margin
edge.
advantage of futures, Michael, that is what we're talking about today, right here, right now in mid-December as the cold seeps in. Hopefully you can get some of the warmth and excitement from stuff like these, the margin advantage that you get from futures. We talk about the slowness of winter and how it takes forever, it seems, and it's no fun. And it's honestly kind of akin to a lot of ETF trades, right? Like they're heavy. They seem like they take forever. And we're going to dip into one of the slowest ETF trades in a second here, using foreign exchange as the example. Michael, first though, can you illuminate for me the difference between, in your mind, this doesn't have to be like a textbook answer. Anybody can go on Investopedia or wherever else and just search for the difference between ETFs and futures. What, in your mind, is the difference between, say, here's the example today, US dollar, the ETF version and the futures version? Because they look pretty similar.
They look extremely similar. And for a while, UUP, for me, and a new trader, was kind of the spot to go, at least when I was looking for foreign exchange exposure. But upon further research, I found this thing is incredibly slow moving and very expensive to trade. Futures, as you can see here, kind of afford the same exposure, but are much more fast, they're more dynamic, and they're actually a lot cheaper and more efficient to trade. So I would liken futures to the a more direct way to get exposure to things like commodities and actually stock indexes and foreign exchange.
And you use some words there that are prime for talking about futures relative to ETFs, which is, faster, they're lighter, but you wouldn't know it from this chart, right? Because it's like, oh, it's US dollars. Any index and all of its variations, whether, it's an ETF futures or whatever, ETP, different exchange traded products there. As long as it's US dollars, it's going to look the same in this setting, where it looks very different and you start to get into that speed and that weightiness of the product is when you look at this, the margin for, in today's example, $14,000 worth of US dollar exposure. In SFX, that's the equivalent of one futures contract. In UUP, that's the equivalent of 580 shares. And, that you don't care so much about, right? Because here in 2020, you've got so much flexibility as a retail trader that the amount of shares that you trade doesn't necessarily translate to more fees or anything like that. But the real price tag that we're looking at today is not fees, but it's this margin. And this is stark in its contrast, Michael. $165 to trade 14 grand worth of US dollar in futures. In shares of the ETF, $6,000. Like, oh my gosh, that's a huge amount there, Michael.
Yeah, it's astounding. And from a trader perspective, this is a really key point. I mean, your capital is your finite resource. No one has unlimited money, but you do want to stretch your dollars as far as they can go. It's almost like, you have an automobile. You can only go so far with a internal combustion engine, like a 6-cylinder or something. That would be like the UUP. You're putting up 50 to 100% of your capital to trade these ETFs. Now you have a future. It's like adding an electric motor to your car. You're getting so much more in terms of fuel efficiency, sometimes even more in performance as well. It's because it's a totally new construct. It's outside the constraints of this ETF wrapper. And that's why you're getting really like 20 to 1 efficiency with the futures versus the ETF, which is just incredible for a day trader, an investor, a hedger, anyone.
And I don't normally mess up, Michael. You know that. I'm pretty good on this stuff. I actually even undersold it. It's 7 grand at 50% here, which is the margin requirement for most stock trades. In some places, it's 100%. 7 grand here to trade 14 grand in US dollars when you're using UUP, the ETF version of this market, as opposed to SFX, the futures version of this market. Now, both products move with similar volatilities, but one has a margin rate that's 3% of the other. Like you talked about, it's like 1/20th, even less of the amount of capital that you need to trade the same market here. And you've got now, once again, on an intraday basis, this market in UUP that's moving a couple of pennies, but costing you for every share, 25 bucks. And so when you want to step up that couple of pennies movement, Michael, to make something worthwhile, you're having to pay thousands of dollars. Here in SFX, you've got, similar movement. It's moving a couple of pennies, about 50 cents. But yeah, it's 3% of that margin requirement of the ETF alternative. And yeah, this isn't like the conversation with me, Michael, and our compliance officer will be happy to hear this, is never like, oh, now since I don't have to put up $6,000 in UUP for or $7,000, sorry, for $14,000 worth of exposure, I can multiply that exposure by 20 or 30 times in the SFX world. No, it's just a matter of, okay, you want to put some US dollar exposure in your portfolio. Mm-hmm. I want to use the cheaper one so I have greater flexibility to diversify elsewhere, or I have greater flexibility if something, happens where Bitcoin moves or gold moves or stocks move, and I want some capital to throw at a trade in that asset class, I have it. Whereas, doing that in UUP, you tie up so much more, you reduce that flexibility. It's not a matter of levering up and just getting, like I said, 20 or 30 times that USD exposure, right?
No, it's about being product indifferent as well. I mean, if you want exposure to US dollars, don't be constrained to just the realm of stocks and ETFs. I think UUP is a fine product. In fact, I traded it for many years because it was the only real great US dollar exposure I could get.
It does what it's supposed to do, right? Like
exactly. But it was limiting in the sense that I couldn't have a position in UUP and also in oil and also in stocks. And the great thing about investing is with the flexibility on platforms nowadays, you can have exposure to all these asset classes and create a portfolio that works together for whatever your investment goals are. And in this case, we're kind of making a case that SFX may be a more efficient use of funds if you wanted US dollar exposure to maybe hedge against stocks, or we've actually seen an interesting relationship between metals and dollar. If you wanted to capitalize on that, SFX and SPRE are less capital than GLD and UUP.
Yeah, and those are great points. I want to get to the other asset classes here in a second, because I love what you're talking about there with, having diversification, having positions in US dollar and oil and stocks and these other markets. That is huge. But before we do that, let's put a bow on this comparison, because what you get at the end of the day is this, a big difference in your potential returns. And this is really, I think, eye-opening for a lot of people who've ever traded UUP. And one of the first things that you probably say to yourself after buying a few shares of UUP is, wow, this thing is not moving. And what you get here is the difference between that efficient margin, whereby if I buy or sell SFX on any given day, I could be up or down 25% here. In UUP, that equivalent is 0.4%, Michael. So like if you're looking at trading foreign exchange and you're looking especially at daily opportunity, we've got Brexit is still going on here at the end of 2020. A lot of headlines in there moving around the British pound and moving around the US dollar as well. And so with that, you say, oh, I'm reading about these stories. I want to get into this market and trade it back and forth. Well, here you've got a product in UUP that even if you nail it and you're looking at, you've got profitable trades, you're gaining on average 0.4% on an intraday basis. I mean, I can't think of a slower moving product, Michael.
Yeah, you're spot on. And that's not to say they can't go the other way. Of course, they can go up or down. But then you add to that with, let's say you're a new trader and you have a smaller account. I mean, that cost to trade UUP is not only going to be crippling, but it's much more difficult to scalp those intraday opportunities. We've seen a lot of great two-sided trading opportunity with SFX, these small little bounces as the US dollar has really just been hit over the last year. But if you're stuck in a small account and getting pinned by the pattern day trading rule, now you have another restriction to work with. No pattern day trading restriction with futures. So not only are you getting the potential 26% return on capital, but also you can be in and out multiple times in the same day, adjusting your exposure and hedging and staying active.
Yeah, and here's the alternative for this. When you see these numbers, these are the two alternatives that you have, which is okay, I put the same amount of money towards this UUP position as I would a stock trade or a metals trade or an energy trade, and it doesn't move so much, or I have to double, triple, quadruple that amount to get it move the amount that my other positions are moving. What's great about futures, Michael, maybe you can speak a little bit to the span margining that accounts for this, is almost all futures, small exchange and otherwise, but we're looking at the smalls here across different asset classes. We have foreign exchange right here. We've got equities, these two markets, metals, and interest rates. All of them move around 20% of that margin. That daily move is around 20% of that margin, which means that I can very easily have equivalent positions in these different asset classes without having to, like we just talked about, like to get UUP to move as much as your SPY position, you're going to have to put aside 4 to 5 times as much capital to get it to move that same amount. And now you've created a system whereby I can't have the both and scenario. I probably have to choose dollars or stocks, foreign exchange or stocks, which is not what we want to do. And you know, going back to, you don't want this efficiency here, this lower price, just so I can lever up and do a bunch of US dollar trades. No, this is what we're looking for, is that efficient pricing, that smaller price tag, so we can get all of these different markets. They all move around the same amount relative to the margin that I put up, and I don't have to do either or, right?
Yeah, and there's even been an emergence of what are called leveraged ETFs trying to fit into this space. And sure, leveraged ETFs may fit in certain circumstances, guys, but we've seen them break on multiple occasions, and it's really trying to fit like a square peg into a round hole. They're riddled with many different problems, which we don't need to elaborate on here. But the beautiful thing with futures and small exchange futures in general is, like you pointed out, Frank, this consistency and the cost to trade is always going to be around 10 to 20% of the notional size of the future. And that has to do with the margining mechanism. Margin is just how much it costs to trade. There's a model called SPAN that looks at things like volatility and max drawdowns, et cetera. You don't need to know all the details and quirks, but you do, it's important to know that's going to be 10 to 20% of the product notional. The beauty of smalls is that traditional futures were swinging $1,000, or I've seen $10,000 in a single day. It's great if you're only putting down 10% of the capital, but that's a huge move for a lot of traders. So small exchange futures are all much smaller in size, all moving around. We can see here $40 to $120 a day. So you can always scale up, but if you're with a traditional future, it's hard to scale down, and that's an important consideration.
Absolutely. And that's what I want to end on, is that idea of, which is really like, it's oxymoronic, the leveraged ETF, because if you do some digging and your brokerage allows you to only put up 50% to buy an ETF, what's funny is the leverage ETFs, they'll usually put a higher margin rate on that. So it's like if it's a 2 times leveraged ETF, but now I have to, instead of putting up 50%, put up 100%, it's no longer leveraged. It's like the funniest thing ever, but it's because these products are trying to mimic this, exactly what we're talking about here today, these margin advantages in futures exclusively. You can't get them in those leverage ETFs because, yes, like you say, they either break, or like I was saying, like it was so funny to me the first time that I figured that out, where I was looking at this leverage ETF and I'm like, why does it cost more? I think it was like a 2 times S&P, and I was like, well, it costs me twice as much as SPY, so there's no leverage. But I mean, that's
completely, it's useless.
It's absolutely useless. But they're tricking people essentially, because they're trying to mimic this huge advantage here in futures, and this is why we stay in this world.